Imagine you're launching a brand new product. It could be a new shampoo, a snack, or even a smartphone. Before the product reaches stores, one critical question must be answered. How many units should we make? Produce too few, and you'll lose sales. Produce too many, and you'll be stuck with unsold inventory. But here's the problem. Nobody has bought this product before. There is no sales history. So how do companies predict demand without any data? As it turns out, forecasting products that don't yet exist is one of the most difficult challenges in supply chain management, and companies have developed some fascinating ways to solve it. Forecasting existing products is relatively straightforward. Companies have years of historical sales data. They understand seasonality. They know how promotions affect demand. They can analyze trends and customer behavior. But with a new product, none of that exists. There are no past sales, no customer buying patterns, no seasonal trends. In fact, companies are trying to predict the future without any direct evidence. And mistakes can be very expensive. Let's look at both extremes. If demand is underestimated, stores run out of stock. Customers become frustrated. Competitors capture market share. And companies miss out on revenue. But overestimating demand creates another problem. Warehouses become filled with unsold inventory. Products may expire or become obsolete. Companies may be forced to offer discounts or write off inventory completely. This is why demand forecasting isn't just about predicting sales. It's about balancing risk. One of the most common approaches is called analog forecasting. Instead of starting from zero, companies compare the new product with something similar. Suppose a company is launching a new chocolate flavor. They might analyze how previous flavors performed, or look at competitor products, or study products with similar packaging and price points. By finding products with similar characteristics, planners can estimate future demand. It's not perfect, but it's often the best place to start. Companies also rely heavily on market research. Before launching a product, they conduct surveys. They organize focus groups. They study customer preferences. And they analyze social media trends. Sometimes, customers themselves provide early clues about future demand. Marketing teams, sales teams, and product managers work together to understand whether customers are excited about the product. These insights help shape the initial forecast. Another approach involves top-down and bottom-up forecasting. Top-down forecasting starts with the overall market. For example, if the total market is 1 million units and the company expects a 10% market share, demand would be estimated at 100,000 units. Bottom-up forecasting works differently. Suppose the company plans to sell through 1,000 stores, and each store is expected to sell 20 units per week. That results in a forecast of 20,000 units per week. In reality, companies often combine both approaches to improve accuracy. Many companies don't launch products nationwide immediately. Instead, they start small. They may introduce a new product in one city or one region. This is called a test market. Sales data from the test market provides valuable insights. If demand is strong, production can be increased. If demand is weak, companies can adjust pricing, packaging, or marketing before a full-scale launch. Test markets reduce risk and help companies learn quickly. Today, artificial intelligence is making demand forecasting smarter. AI can analyze search trends, social media conversations, competitor launches, customer demographics, economic indicators. By identifying patterns across thousands of products, AI helps companies make better predictions, even when historical sales data doesn't exist. But AI doesn't eliminate uncertainty. It simply helps companies make more informed decisions. Predicting sales without data may sound impossible, but companies do it every day. Through analog forecasting, market research, test markets, and AI, businesses make educated bets on the future. Because in supply chain management, forecasting isn't about being perfect, it's about being prepared.